Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel and Escape from the City on the ABC. And Ben Kingsley, Chair of Property Investors Council of Australia and the founder of the 2018 Property Investment Advisory Firm of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property finance and money management. Hello, Ben.
Hello, Bryce. How
Milestone
are you?
episode.
A little 250.
250.
Let's not build it up too much. But what a big show.
Still got to raise the bat.
Yes, true.
Still got to raise the bat. We're excited to hit 250. Hey, you're looking refreshed for a bit.
No, overseas. It's a little bit of, flop and drop holiday in Thailand. There you go, if everyone wants to know, with the family.
Very good.
No, all good.
Well, you're
Thank
looking
you for
refreshed,
asking.
mate. So no doubt you're chock full of listen to a bunch of gear.
Ideas. I've got ideas, bro. And I'm just so excited about today. I've been waiting for this for several weeks, if not a couple of months.
We put the challenge out to you to bring an epic guest.
Yep.
And you delivered, I've got to say. Yes. As much as that pains me to say that you delivered, you did, because today's guest is a highly articulate, highly intriguing, and tells a good story. Tells a really, really good story. So stick around, folks. We've got a very special guest. But a couple of things to mention on our 250th, Ben.
Yes.
Number one is we are now well in excess of 5 million downloads, Ben.
Wait a sec, Bryce. I need to get me... There we go.
5 million downloads is significant, because what that means for us is we started way back when in the idea of helping a few people, and the fact that number means that the message is getting out there and we're getting to impact some lives, which is really, really cool, right? So we're going to give some gifts away to celebrate that milestone, Ben. But just so for those people who want to play at home and they like detail, Ben.
Yes. What are we at, mate?
We're at 5,285,722 downloads. Over 5 million of those on iTunes alone. So there's Spotify and a few other places that you can hear us. So
there you go.
Very, very special thanks to the folks out there who have supported us over many years. And we certainly look forward to the day, Ben, when people come up to us and say, hey, look, I implemented some of the stuff that you guys talked about. It has made a difference. Thanks for the effort. So a little shout out to a wonderful teammate here who does not ever speak, Ben.
Yep.
Does not ever speak.
What episode? There was one episode. It was the 100th, wasn't it?
It
where
was
we
the
got
100th.
her to introduce.
Yes.
If you want to hear Ivis. It was.
But Ivis has been a wonderful contributor to this podcast, because for those people who can't get up to speed, we've got reports, we've got catch-up guides, we've got binge guides. Emma's on our team as well, who's collated all of that. So well done to you, Ivis, as well.
Big shout out. Without Ivis, we cannot do this program. No. And all of the free stuff that she puts on the website does an incredible job, her and Emma. So thank you very much.
Loads and loads of free stuff. So ultimately, the aim and the goal was to just give back to our community, Ben. And so as we sort of raise our bat to 250, we just wanted to acknowledge that. So we've got some gifts. I'm going to talk about that very shortly. Don't normally do this, Ben, but the Your Investment Property magazine made our business the winner of the Property Investment Advisory of the Year award, which we're very proud of, because for two reasons. One, it's been running for 2 years, and we've won it for 2 years. And it also is on the back of you being the Property Investment Advisor of the Year in 14 and 15. So,
the fact is, I've got an existing group of clients that I still look after, but I don't take any new clients on because I've got a full book. That's very difficult. You can't, because this is not just about, when you build a property plan, it's not about a transaction and go away and do it. You've got to look after those people and make sure that they go on that journey and you're tracking them and looking after them over the longer term. So that's why there's now a team of people that do that.
Well, I was about to say, that's part of the legacy, isn't it? That we can help more people by ensuring that the team that we hand select ourselves, both for me in the buyer's agency team and for you in the property advisory team, whatever comes out of our mouth comes out of their mouth, because we are 100% in alignment. So that's a nice feeling. It's a little bit self-indulgent of us.
Property wealth planning team, good on you guys.
But we wanted to acknowledge that. And the last thing for me on my intro here, Ben, is Footy tipping.
Footies. Let's talking
I
footy. Prelim week, Bryce. Prelim week.
I purposely left it to the end.
Who's down into the last four?
So that we
Whilst I've been
didn't
away
have
for
to
a couple of
indulge
weeks.
you. But clearly, do you want your moment in the sun? Who's in the top four, Ben? Who's made it?
So there would be GWS.
Yes.
There would be.
I like the way you're doing this.
Cats.
Yes.
There would be the Tigers.
Right, and that's
Ibises, obviously. And then there's another team called the Magpies.
Yep. So
yes,
they let's all, for the beneficiary of everyone in Australia, Ibis, let's just hope that GWS makes it to their first grand final. So
you know, here's my thing, right? I want GWS to win a flag. I think they're talented enough. Just now that they're playing us, it's sort of a bit difficult. But I will be there on Saturday, supporting my team.
Follow Geelong and Richmond, so it's an interesting time this year.
Oh yeah, Friday night at your house is going to be an interesting affair. There'll be a lot of barracking going on.
And for our folks who are at the pointy end of our competition,
the footy tipping, yes.
I had a little sneaky check, and the top two are equal, Ben.
Ooh.
So it is.
So the next 2 weeks are it, and then we'll be announcing who gets our major prize, which is a property portfolio plan developed by our team.
Valued at close to $5,000. So my mindset minute today, Ben, to mark this occasion,
yes,
is a quote that I heard the other day. I can't remember who said it, right? But it says, "The grass isn't greener on the other side; it's actually greener where you water it." And so I thought that's relevant in so many ways. True for relationships. So some of our people who are listening to this may be having some challenges within their own domestic life around their relationships. We, of course, saw a very sad event in recent weeks with in the AFL with Danny Frawley, who was challenging, was battling some mental health challenges, Ben.
Yep.
So what came out of that was we had the service yesterday, and there's a movement that has come from that of people that it's okay. You had Are You Okay week last week, Ben?
Yep.
So for people who are listening to this who may be suffering in silence, it's okay if you're not okay. And what's important is two things. One, you talk to someone as quickly as you possibly can. And two, you realise that the grass isn't greener on the other side. Your circumstances are fine, you're okay. It's greener where you water it. So it might mean that you need to water it through reading the right material, talking to the right people, taking on the right response to whatever's going in your world, Ben. We're going to put a link in the show notes from a eulogy, Ben, which Wayne Schwass delivered at that memorial, which I think is really important for people to read if they even are on the shadows of feeling that way.
Yeah, watch or read it,
particularly those who are definitely feeling that way. So if we pivot just back to property, changing tactics all the time is the equivalent of thinking that the grass is greener on the other side, Ben. My invitation to people is go deep, water the basics to enjoy a healthy garden. Don't just listen to the principles once. Study them until they are an unconscious competence. Like driving, when you were 17, Ben, or 16 3/4, that was a conscious uncompetence that became a conscious competence. And now when you drove to work this morning, it's an unconscious competence to you. So we want you to have that around money and finance and property. So it's not okay just to go, I've heard it once, move on, change tack. Hear it once, hear it twice, hear it 3 times. Go deep into the basics. Because, folks, I'll say it again, the grass isn't greener on the other side, it is greener where you water it. Now, Ben, that is why you and I started this podcast.
Yes.
Because we wanted to get information that was out there that we wish we had when we started investing in property, number one. And two, we wanted to make sure we did our part in making sure people didn't get burnt, didn't get stung when it came to investing their money. Because you and I were talking before hit record about how you were having a conversation on radio recently about some people who were in the latter part of their life who are having some financial troubles. I think it'd be worth sort of...
Well, there's documentation out there that there are obviously people in all, age ranges through their lives who are having financial difficulty, right? In this particular example, and many that are reported in the paper about these people, in this particular case, there was a couple who were renting, right? And their pension covered their rent. Now, that's the worst position you ever want to be in. Effectively, you have no wealth base. You're basically renting And if your pension isn't big enough, then ultimately you've got very little to live off. And that's not a quality of life. Now, the backstory of that particular couple is that they chose to sell their house to travel around Australia. And when they travelled around Australia for a period of time that they did, the value of that property went up, potentially, doubled over that time. And then they decided to put their money into the markets and the GFC hit. And then they took their money out of the markets, and that's when the recovery comes through. So they've made some classic fundamental mistakes around decisions around money and investing, right? And in most cases, the people who are being reported as being in difficult financial situations throughout the course of their lives have made 1, 2, or 3 fundamental mistakes when it comes to caring for their money and taking care of that money. The first one is usually they spend more than they earn, right? That's the classic one. The second one is that they've got caught up in some type of get rich quick and they've gone too aggressive rather than, as you say, continually keep watering and fertilising the ground, and over time you'll harvest what you sow. And then the third one is in regards to, the fundamental mistakes they make is that they don't plan, so they're not doing anything. They're rushing, they're ad hoc. If you do those 3 things really smartly and get advice, because again, I'll come back to what our special guest, I was about to mention his name, but our special guest for today's video, because there's a trend that I'm seeing in all of these high profile, successful, financially free people that we're interviewing, and I'll share that after we talk with him.
So Ben, what you just said is, folks, the difference between success and a mediocre retirement is just a couple of key decisions made either well or poorly.
Yep.
It's not a lifetime of poor decisions, it's 1 or 2 key poor decisions that if you have the frameworks to better understand, you might not make those mistakes.
Correct.
So what are we going to do about it, Ben?
Well, Bryce, what we're going to do, and here's the biggest giveaway that we've ever done on our podcast.
It is.
Okay. So the first book we wrote was obviously The Armchair Guide to Property Investing, right? $2,000 a week, that's what we were trying to do. But as part of that, there was also the money management piece, right? So then we wrote the second book, which was Make Money Simple Again, right? Now,
prequel, Ben.
The prequel of the first book. Now that book has also gone on to become a very, very bestseller in the business section, right? So we've sold thousands of books, but today, Bryce, we are going to give away that book. Now let me put this into context. What we're going to give away, free for everyone for a limited time who are listening to this as part of our 250 birthday celebrations, is we are going to give away a Choose Your Own Adventure copy. Now what does that include? That includes effectively the entire book. Okay, all of the instructions, all of the pieces that help you organise and manage your money, right? And that is now going to be given away free, and we're going to give you the link in a minute, right? Now, and then you choose your own adventure. Now,
that's 100% discount, Ben.
That is, Bryce, and it's a PDF book straight to your inbox. All right, it's a digital version of the book straight to your. And what are the 4 different case studies that you can choose from?
You'll get the first full 8 chapters, Ben.
Yes.
And then you get to choose your own adventure, as you mentioned. Yep. So if you relate to the credit card debt disaster, you can choose that version. Or if you relate to the rapid home deposit builder, you can choose that version. Or if you want to go mortgage and debt free, that's your version. Or if you're the fourth category, if you want to build wealth, Ben, what does that look like? So we decided that we could keep the book in the bookstores and try and sell maybe a few thousand.
A few more thousand.
Yep. But you don't necessarily get the dividends unless people really get this en masse, right? So this is our opportunity. So as you said, we're only going to do it for a limited time. So you need to, if you're listening to this, forward it to a friend. Let them see the podcast. You can go on there and you can get the digital copy for free, Ben. So where you'll go, it's really simple. Just go to makemoneysimpleagain.com.au. That's it. Now, folks, go there as quickly as you can because we're doing it for a limited period of time, Ben, because we want people to take action. We want you to water the grass on your side.
Email that web address to as many people as you possibly can for the time that's made available, because we've moved from a crusade, Bryce. We started off as a crusade and now it's a movement. We've got on our Facebook page, our Facebook group. There's over 1,000 people now who are sharing all of their knowledge, passing that on. So it has become a movement, and it's all about making sure that we help people organise, understand and control their money, right? We have been beating on about this, and I see, this is that state of wallet plays with your state of mind, and that's where challenges live for a lot of people. So why would we just limit it to a few? We want as many people out there to have that. So we're also talking, and it'll teach you how not to leave money on the table, all right? It's about how you trap more surplus using a rules-based system. Tracking your money does not do anything. It needs to be a rules-based system. Now, in support of that, Bryce, what we've been also doing in the background is we have gone and completely upgraded the Make Money Simple Again portal, right? So we've now, the Money Smarts platform has had a complete reboot.
2.0. What?
Right, so now it's 2.0. So you're going to see a lot more information. So what you do now is effectively you've got the instruction manual, which is the book, and you've got the free My Wealth Portal platform.
So people can go deep on the basics now, Ben. They can read the book for free.
Yep.
And they can actually use the platform for free.
Set it up on the platform for free. And I've got some exciting announcements over the next couple of months in terms of how you can get better insights around how you're comparing to people around you. So this is moved, it's a movement now. We are building a community of teaching people how to organise, manage their money. Then one day, they should be able to invest that money, right? But for some people, it's if you've got to get your credit card under control to get yourself back in order. If you want to basically save for a deposit, like some of our people, the biggest challenge for buying your first home is saving a deposit. Okay, now if other people want to be debt free, we'll teach them how you can be debt free as well. And then finally, those ultimate people who want to build wealth for financial peace. It's all in there as well.
So folks, if I've ever done this before, I cannot remember, but I want you to pause the podcast right now. I want you to go and click on the link, or actually pause it in 10 seconds. Go to the link in the show notes, go and get that free book now while it's fresh. Go and put your details in there, send it, then come back and listen to our very special guest, because we want to put our money where our mouth is. We want you to water the grass on your side of the fence. We don't want you to be peering over the fence and thinking that it's the grass is greener somewhere else. So, folks, two things. A, go and get it now, and two, go and tell as many people as you possibly can, because it's going to be available just for that limited time.
Now, Bryce, people might also be thinking that the platform, okay, so the new 2.0 version of the Money Smarts platform, which we now call the My Wealth Portal, is going to one day be a cost, right? I can guarantee you that as long as I'm alive and we're in business, that platform will be completely free for the fundamental Money Smart system. We will never charge for that. Never charge for that. In the future, we've got big plans for other things, but you will always be able to organise, control and trap your surplus and check in every month and continue to manage your money. We will make that commitment to everyone, because people are saying, it's free today, but one day it's not going to be free tomorrow. I can promise you the fundamentals of Money Smarts will remain free forever, so long as I'm alive.
Yeah, because you've got a mission. You've set it before the day that you start. You feel like you can make a difference in every single person's life, and that's one of the ways that we can do it. So folks, if we haven't laboured on that enough to the point where we think it's really important, we are well and truly wanting to invest in your financial foundation. So go and check it out. Go and check out the portal. That's certainly going to help you.
MakeMoneySimpleAgain.com.au.
So Ben, we flew up to Sydney.
Yes, we did.
And we recorded with this very special guest.
Yep.
We are, of course, talking about Roger Montgomery.
Yep.
Now, Roger did not let us down. We were both excited at the thought of being in the room with this guy. He's a very smart, intelligent investor. And he is the Warren Buffett of Australia. He is a value investor. And we wanted to talk about what are the principles of value investing that you see in the stock market. And so we can use those as principles to overlay into the property market. It was a fascinating chat. I enjoyed every moment. Let's cut to that interview now. All right, Ben, so today we've got a very special guest to mark our 250th episode. We have Roger Montgomery, who's the Chief Investment Officer and founder of Montgomery Investment Management, which is a Sydney-based specialist boutique equity manager that manages $1.5 billion on behalf of private investors, their advisors and families. Through a simple, common and time-tested philosophy, Montgomery manages several value-oriented, I think we're going to touch on value-oriented shortly, funds focused on the various aspects of quality to generate superior returns over the very long term. So we're going to unpack that a little bit. Before we do, Roger's 26-year background in financial markets includes equity analysis, equity and derivative trading and investment banking. In 2010, Roger published his first book entitled Value Able, How to Value the Best Stocks and Buy Them for Less Than They're Worth, which went on to become a bestseller. Value Able sets out his 3 simple steps for value investing and online trading. Welcome to the Property Couch, Roger.
Great to be with you guys.
And you forgot one thing, he's a Melbourne boy as well, but you know, in terms of happy to be in Sydney by the
Originally Melbourne. I feel I'm qualified to compare Sydney and Melbourne.
How long?
Because I've lived in both almost an equal amount of time.
Okay.
Yeah, just a couple of years longer now in Sydney.
Yeah.
So therefore you'd have a football team?
I still go for the Tigers.
Okay.
Yeah, still go for the Tigers. Gosh, it was a long time between drinks. Gosh, it was a long time. 1980. I think I was in grade 2.
Did you get down and celebrate, or did you?
I watched it from here.
Okay.
Yeah.
And is the passion still strong, or is it sort of worn off a bit living up here?
No, well, living up here, there's so much to do beyond football and watching it, you know. And I'm a very active outdoorsman, so I did, when I was living in Melbourne, always was up at Falls Creek Family from a little town called Mount Beauty in northeast Victoria.
Beautiful.
We have a property down there, a farm down there, and so did a lot of skiing, a lot of hiking in the snow, a lot of camping in the snow. And up here, there's not the snow, but you know, there's a lot of canyoning, there's a lot of outdoors, and on the harbour, being on the boat on the harbour is unbelievable. In fact, it's the best way to experience Sydney.
It's the most beautiful harbour city in the world. There is none better.
I think it's extraordinary. You're on holidays. The second, Friday sort of early evening ticks over. It's just great in the summertime.
Now, Roger, you got that CV is very impressive. Your opinions are sought out. We listen to you regularly on Ross Greenwood's Money News. So before we unpack that, can you take us back to the beginning? You're a Melbourne boy, and you're about to embark on a career that includes, investment banking and equity analysis. What did that look like? You graduated from high school, and where did your path go at that point?
Well, I went to Melbourne University. I thought if you went to university, all my peers, all my friends at university were doing accounting subjects, and I thought that's what you do with your accounting subject. You become an accountant. Mm-hmm. And we had Price Waterhouse at the time, and Arthur Anderson, and various others come to the university, come on campus, and pitch their summer vacation jobs. And they interviewed us and selected us, and then they'd give you this pep talk and say, you're the best of the best, and we want you to come and work for us. So I went to work for Price Waterhouse in the summer of, might have been 1989 or 1990, too long ago now. And I can remember we there was sort of 3 days of sort of orientation. Mm-hmm. And the final meeting we had was with the Asia Pacific partner. He was the director of the entire Asia Pacific operations of Price Waterhouse, and he had a corner office there in Spring Street, I think it was, in Melbourne. And the last thing he said, and I'll never ever forget it, and he said, and if you have any questions at all, come up to my office and see me. And I just parked that. And of course, nobody knows this, but I grew up with a mum and no father. My father died when I was 2, so there was just my brother and myself and mum. There wasn't really any hierarchy in our home, so I didn't understand hierarchy at Price Waterhouse. So after 3 days of twiddling our thumbs, of not actually doing anything, so we finished this orientation. We were sitting around in a sort of a boothed area of the office. We literally read the papers for 3 days. We had nothing to do. There was no work on. And I got bored. So I thought, I remember that bloke said, come up and see him if you've got any questions. So I knocked on his door, and he had an ante room. Yeah. So there was a sort of a reception room, and then there was his office. And I spoke to his assistant and asked if I could see him, and she asked what that was about. And I just said, look, just wondering if you have any work on. And she said, what do you mean? And I said, well, there's nothing to do downstairs. Everyone's been reading papers. So all the summer vac guys, there's probably 10 of us or 12 of us, we've got nothing to do. Do you have any work on? And I'd love to do something for you guys, if there's something available. Anyway, she went in and he came out and we sat down and he organised some tea. I think I had a hot chocolate and didn't like tea. And he said, what's going on? I said, well, there's 10 or 12 of us down there and we've been reading the paper for the last 3 days, but really I'm here to work and to learn something, and I'd really like to get some work, and I'm thinking maybe you've got something you'd like me to do for you. I'm happy to do that. Anyway, unbeknownst to me, you can imagine how many chains of command there are between the Asia Pacific partner and the junior auditor who was going to give me a job. There must have been 32 links and 32 butts that were kicked until it got down to me. So long story short, everybody hated me as a consequence of that. And for years later, people would come up to me at parties in Melbourne and say, are you Roger Montgomery from Price Waterhouse? I said, yeah, that's me. Anyway, so they gave me this really horrible job with a guy who played hockey for Australia, actually, grass hockey for Australia. They gave me this terrible job of auditing the chits, the bond trading chits at the Bank of Singapore. And so I was sort of tucked away in a broom closet in the bank, and I had to check the calculations, the bond calculations that were written on these notes to make sure that they reconciled with what was actually traded. And that was like the worst job that Price Waterhouse could possibly give anyone, and they gave it to me for obvious reasons. They just didn't like me. But what happened is while I was there, literally while I was there was an explosion in the room, in the bond trading room, and paper was flying everywhere, and there were guys swearing and spitting, and at the time that seemed really exciting, and they were yelling at each other, and they were throwing everything, they were smashing their phones, and I thought, oh, what's going on? This is amazing.
Are we in October of some year?
We are at the, what ended up happening, you're close, but I went out and I was told not to leave the closet, and I did. I came out.
Well, that was established
like Harry Potter. Yeah, it was clear that I'm not going to
follow instructions.
Yeah. Well, I did follow instructions. You just come up and see him.
That was very good.
I did that. Anyway, so I went out there, asked one of the bond dealers what was going on, and he was pointing at his Reuters screen. Back then, Bloomberg, I don't think Bloomberg had really taken off at all. And there was just this green text coming across the screen, and it said the first sortie of jets had taken off to bomb Baghdad. This is the first Gulf War. This is George Bush Senior. Right? Yeah. And I asked for a phone, and they gave me a phone line, and I called my mum, and I said, Mum, they're going to bomb Baghdad. She said, how on earth do you know that? It's not even on the news yet. I haven't heard anything on the radio. And I thought, that's the job I want. I want to know something before everyone else knows something. This sounds really exciting. So I called the dean of my faculty, and fortunately I was getting reasonably good marks at university, and I had to work hard for it. I wasn't naturally smart. I really have to work at it. And I changed all my subjects. So I kept financial accounting, but then I moved into econometrics and statistics, and loved mathematics. So I did some higher maths, and ended up switching away from thinking about being an accountant to working in financial markets. Then we had the recession that we had to have, and I was one of the fortunate ones that got a job with a stockbroking firm as a junior analyst. Ended up working at FW Holst, which is now owned by Baillieu's. It's Baillieu's Holst, and worked there for a year, and then received a completely out of the blue phone call from Bankers Trust here in Sydney.
BT, yeah.
And BT Australia, they called me up and they said, we want to take you to lunch. Took me to lunch. I'd never been to Sydney at that stage, and I didn't know a soul up here.
Yep.
Took me to lunch. I tell you, the first impression I had of Sydney, the size of the Harbour Bridge. I'd only ever seen it in a postcard or on television, and it was enormous. It was overwhelming. And we had lunch at one of the restaurants on the harbour underneath the Harbour Bridge, and I just kept being distracted by this enormous structure above us. Anyway, they offered me a job, and I didn't realise it was a job interview. I thought it was just lunch.
Yeah.
had, of course, completely naive, didn't realise you don't get invited to lunch for a chat. You know, there's always an ulterior motive. There's an agenda.
But what had they seen that you didn't realise was on their radar?
So what I was doing in the background, in addition to analysing stocks, is I was trading my proprietary account with a mate. We were trading futures, and we thought we were doing reasonably well. Initially, we were doing incredibly well. We ended up losing all the money that we made, but our orders were obviously going through a broker somewhere close to where BT Australia was operating in the pits when Sydney, the futures exchange was running pits. They must have wondered who was putting these trades on. They were tracking them, and they called me and offered me a job. Okay. And I moved to Sydney and knew not a soul. Worked the night shifts and worked overseas markets and traded overseas derivatives. Enjoyed that enormously, and then went from there. Mm-hmm. Long story to a short question.
No, we love the long stories. And in terms of obviously growing up without a father and having a mother as the matriarch of the family and a brother, what was money discussed in the household? I mean, one of the two big things. Yes, it was
discussed all the time.
Okay, great.
There was never enough.
There was never enough.
There was never enough. And my mum was paid fortnightly.
Yep.
And so the common refrain when I asked for something as a kid was next fortnight. Yep. And I remember throwing a tantrum because this was at Moonee Ponds. We were at Moonee Ponds, somewhere near Puckle Street.
Yep.
And I remember throwing a tantrum because all the kids at school had Levi's jeans, corduroy jeans, and we had Jabs. Jabs were a Target brand.
Yep.
And I can remember crying because Mum wouldn't buy me a pair of Levi's, and I threw myself on the ground. I can remember it. I was in primary school, and I ended up years later remembering that story or remembering that experience. And I asked Mum, I said, "Mum, why didn't you end up getting me the Levi's?" And she said, "Because they were $9 a pair, and I was earning $14 a week. You know, I just couldn't afford it. I couldn't get it for you." And that taught me a great deal about the value of money. You know, there were a lot of experiences like that. That was just one of them. And to this day, my mum works like a Trojan. She's a hard worker, and she delivers the local newspaper. And it was interesting. I offered to pay her to not have to do that anymore. And she said to me, "But how would I get my exercise and chat to the neighbours?" You know, and I thought the's value in work. You know, there's a community aspect of working which a lot of people forget when they give up work. And there are a lot of people who are unhappy when they're not working for that reason.
So was it always a love of numbers, or was there, like, you know, did you know that in your earlier years coming up through primary and high school, or was it a combination of numbers and reading?
I was very good at maths, and then I switched schools I went to a state school up until year 10, and then I went to a private boys' school for year 11 and 12. I got a partial scholarship. My maths in year 10 was top of the class, but it wasn't good enough that the school wanted me to do what was called Maths 1 and Maths 2.
Maths A, Maths B.
Back then it was Maths 1 and Maths 2. And I wanted to do Maths 1, Maths 2, Physics, Chemistry and English. The Magic 5 it was called, to be an Air Force pilot. And the school said, "Look, you're obviously bright, but you're behind, and that's because you went to a state school. So why don't you just do Maths 1 and not all the others?" And that, I guess, kept my hand in with mathematics for year 11. But then in year 12 they said, "You're still not strong enough that we're confident you're going to get a high score and keep our numbers looking good." Correct. So, you know, do economics instead. Ended up doing very well, and a lot better than some of the other students who'd been at the school their entire school life. In fact, did very well, got to Melbourne University, and then I just took up the maths subjects.
Found yourself on a commerce pathway as opposed to a science pathway.
Yeah, and then really enjoyed, you know, Lagrange functions and calculus. And what was great about maths is at the end of the process, you know if you got full marks or not. You know, there wasn't any interpretation, there's no subjectivity, it's right or wrong. And that was, for me, that was liberating. And the university was a little bit easy because they gave you extra marks for attempting the maths questions instead of the essay question. So in every subject, they gave you a maths option or an essay option, and you were given an extra 5 marks if you attempted the maths question. And fortunately, I knew at the end of that maths question, you know, I got those answers right. So that was really helpful.
What did the fortnight, we'll get that next fortnight, what sort of impression did that leave on you as a kid? And what, if any, of that carries forward into the way that you manage your money as an adult?
So I became a very, very good saver. And I read a book in my early teens, a book called The Richest Man in Babylon, which I haven't read since, and I should give it to my kids actually. And the one thing it taught me that I'll never forget is pay yourself first. You know, whenever you get paid, pay yourself first, put that aside, and then with what's left over, fund everything else. And if you can't fund everything else you want to do, then you just don't do it, because that money is yours and you're using that for saving. I call it wealthing. You know, to get wealthier. And a couple of examples of that, I remember as a 13-year-old boy in 1983, I worked 2 paper rounds. I worked a morning paper round and an evening paper round. And I also, after the paper round was over, I went and cleaned up the butcher shop. This was back when they had sawdust on the floor, and I had to rake the sawdust and wash all the trays with all the blood. Ended up getting horrible dermatitis on my fingers from all of the chemicals in the water. But I had 3 jobs as a 13-year-old, and I remember
buying those jeans?
No, I didn't buy the jeans, and never got them. I don't think we ever got. Maybe we did. Mum will probably be upset. Maybe we did get them. I don't remember now. But I ended up buying a camera. I was really into photography, and I ended up buying an Olympus OM10. And the reason I mention that is it was not top of the range. The OM1 was the top of the range, but the OM10 was sort of second top of the range camera. As a 13-year-old boy, spending $384 to buy a camera and a lens, you know, that was pretty unheard of, you know, to buy such an expensive camera at such a young age. I got home and I vomited. Mum drove me to Nunawading, to a camera store in Nunawading, where my grandfather, he was a very keen photographer. He said, they're a very good camera and trusted camera shop. You should go there. They're in Nunawading. Went there, brought the camera home, ended up vomiting. And Mum,
because of the adverse reaction to spending the money. Because
I worked so hard to spend that money and for so long to save that money, and worked so hard and so long, and when it was all gone, I vomited and was crying, and Mum didn't know what was wrong. You know, she was trying to comfort me. And then when I told her, finally I could get my words out, and I said, I've spent all my money. She said, oh, you bloody ridiculous, you know, we just don't spend it again. And I thought, oh, that's a good idea. I won't.
Well, then you've got to take the photos and get them, you know, processed.
And then in my very early 20s, when I started working up here in Sydney, I moved from BT across to Ord Minnett, Jardine Fleming. And there was a wonderful guy who took me under his wing, a guy named Bruce Bradshaw, who was the CEO of Ord Minnett Futures.
You didn't tell him you were reading the newspaper for the previous 3 days?
No, he was a brilliant manager, and he did a great job of encouraging people. He did a great job of building camaraderie in a team, and he knew I didn't have a dad, took me under his wing and looked after me financially. But then one day he asked, I'll never forget, it's another sort of saving lesson. One day we were having a conversation about a raise, and the reason we had the conversation is I'd come in and I said, Bruce, I've been working really hard for you for a year, and you know, I'd really like you to reconsider my salary. And he said, what sort of money are you talking about? And I said, I'm looking for an extra $10,000. And he said, $10,000? Rog, that's like a dinner a week. It's a tie a week, a new tie every week. Is that all? Go away and come back to me when you're serious. So anyway, so I left with my tail between my legs, and I came back in one day and a few weeks later, and I said, I've reconsidered the salary conversation, which, remember, I'm one of the most junior people in the firm. You know, he's probably forgotten the conversation. Anyway, I've come back in and I've said, Bruce, I've reconsidered the salary question, and I've thought about what you said. And he said, okay, so what do you want to talk about? And I said, well, I want to talk about this raise. He said, oh yeah. Well, how much are you thinking, Rog? And I said, well, I'm thinking double. Maybe you could double my salary. He went off. He was swearing and banging the table, and the glass the glass was vibrating in his office, and everybody out on the trading room, you know, they were looking in and cracking up laughing, and you know, because I'm being absolutely smashed. Anyway, and then he calmed down, called me back into his office again after kicking me out, and he calmed down and he had a chat to me about money. And he said, what are you doing with your money? I said, I'm just saving it. He said, what do you mean? How much have you got? And I said, I've got $250,000. Hang on, you're 23. You've got $250,000. How'd you get that? And I said, well, I've just saved. And I don't own a car. You know, I ride my bike to work. And he said, Roger, I don't have $250,000. That's amazing. Well, you should go and borrow to the eyeballs and buy real estate, you know. And I thought...
So what are we talking, the 90s? Was that...
This is early 90s, very early 90s. So first or second year out, right? So I spent a year at FW Holst in Melbourne, then a year at so it would be 93, I reckon, 93.
Wow, it's extraordinary.
Just on the recession.
Yeah, so I was 23, I was 22, 23.
Back into the recession. Yeah.
So it saved a lot. And that was all because of that fortnight question that you asked. You know, Mum saying, next fortnight. And I kept thinking, blow, I can't buy anything. I can't have anything unless I get some more money. So I learned to save.
Well, I had a client who had, we called it financial anorexia, but they had saved $1 million.
Yep.
This was 5-6 years ago on the show. And they had got so used to logging on and checking out the balance that they were not able to part with it. And
so that's a lesson that when I was at Merrill Lynch, that's a lesson that we gave winners of the lottery. So we had some advisors that were appointed to advise lottery winners. They often came to Merrill Lynch Australia at the time. I don't know where they go now, and I don't know if they go anywhere at all. But one of the pieces of advice that was given to anyone who won lotto was to not spend a cent for 12 months. To actually put it in a term deposit. Don't invest it in any volatile asset. Just pop it in a term deposit. Back then, obviously, the returns were a little bit better than they are today. But pop it in a term deposit and just get used to owning that amount of money and spend the income, but don't spend the capital. And by the end of the year, the theory was, and it worked for many people, that you got used to having it and you couldn't part with it. You didn't want to spend the capital anymore because you realised it actually was an asset that generated income for you. So you didn't spend beyond your means. You didn't go and buy a boat called Pink Lady and, you know, and a jet ski and all this other stuff that people spend money on when they win lotto. So you're right. You call it financial anorexia. I just call it rational thought. It's just rational thought.
But it can't be rational thought if they don't spend it at all. Like, in other words, there's people that go through life. So there's always outliers on both sides.
Indeed.
There's people that money burns a hole in their pocket, and then on the extreme other side are these people who hoard it. And they just cannot let it go. And so their mindset of control, the money is now controlling them. Getting that balance right between, you know, living for today and also putting away for tomorrow is part of the crusade we're on, because there are so many people who, it's really the other extreme, which is money burns hole in the pocket and they're using credit to get through life and the whole thing's a mess.
Yes, so an example of those who don't spend money, a very good friend of mine who's a stockbroker shared this story with me. He met a couple and during the course of the interview, the getting to know you sort of interview, brokers have to meet a sort of know your client test. The gentleman's wife was upset that the husband was only letting her spend a couple of $100 a week on groceries, and she wanted to spend a bit more, but he wouldn't allow it because the income wasn't sufficient they didn't have enough income to spend any more than that. And when they got to the nuts and bolts of the finances, the broker was telling me he realised that they had probably $2 or $3 million saved, and they were in their 90s, and it was okay to spend a little bit of capital at that stage. But yeah, they were an extreme example, you know, where they just couldn't let the capital go, or he couldn't anyway.
We've got thousands of clients, and we've got, you know, over 10,000 people on our platform.
Yes.
And so we get to see all extremities, you know, people who are earning $5 million a year to households that are earning $110,000 a year.
Yeah.
And it's just fascinating in terms of their approach to money,
Yep.
and their mindset or psychology or their money behaviours or their money story, right?
Yes.
So, you learnt very early that there is incredible value in saving money.
Yep.
And it's transformational when you can do that. Going to the extreme means you probably will never buy anything because you get this adverse reaction and you don't like this adverse reaction.
I've overcome that a little bit. I've had to. I've got 3 children. I've had to overcome the spending. I let someone else handle the actual payments, so I don't have to do it myself.
Do you walk in the house like me when I say, what is this, Luna Park? I mean, how many lights do we need to have on in this house?
Yeah, no, we're all very good at that. There's not many lights on, but yeah.
So Roger, can we close that loop out? Because you're clearly, Ben and I have observed you for some time, so clearly you're successful in your space now. But what's the next step when someone advises you, you've got $250,000 in cash as a 23-year-old, and he says to you, go and hop up to your eyeballs and go and buy real estate. What was your response and what did you do?
Well, the sad thing is I couldn't bring myself to spend the money, and investing in property felt like spending. It didn't feel like owning, having wealth, which is silly at the time. It subsequently took me getting married to a girl who was quite savvy with property. She already owned a property in Mossman, and I was quite stunned by that. And when we got married, we had to buy a house. She had to drag me kicking and screaming to buy our first house. Now, to put this in perspective, we bought a house in the inner west of Sydney, in a little suburb called Russell Lee. It was just over $415,000. I think the deposit, I think we paid $300,000 cash, and I wanted to keep some money to start a business. So we'd worked it out that we needed to borrow some money so I could have some money to start the business. We couldn't borrow after I started the business because the bank wouldn't lend us the money. So we had to buy the house, take out a mortgage while I still had the job. Then I quit the job, and then
So you got a facility to the side, a little bit of equity or something like that to the side?
Yeah, we ended up. Well, no, it wasn't that sophisticated back then.
Okay.
No, you just borrowed the money and paid it off, and that was it. And then offset accounts, I think, weren't around back then in the mid-90s.
Yeah, they came in late 90s, I think.
Yeah. So this is
Australian
97, 98. Yeah, they didn't have an offset.
Yeah.
So we ended up, in fact, I can remember all the articles in the newspaper talking about these new offset accounts and how good they are. They are fantastic, by the way.
They are terrific.
If you're disciplined with money, they are fantastic.
Agreed.
So, my wife ended up dragging me, kicking and screaming to buy this house, which was not a risk, considering, we ended up, we had sort of a 75% or 66% deposit, 75% deposit.
Yeah, 30% loan to value ratio.
We had this, massive deposit, and it was no risk, but I was still petrified. And we ended up owning that house for only 4 years, and we doubled our money on the property, which is great. That's better than 15% per annum.
Yeah, exactly. Yeah. That's crazy.
Yeah, mind you, the last one that I just sold a couple of weeks ago, I worked out we made 3% per annum on it over 13 years. I bought it at the peak of the GFC, the peak prior to the GFC. Pre-GFC. Yeah, my neighbour at the time actually said, "Oh, you've overpaid for this," and I said, "I know, but gee, it's a nice house."
Yeah, it's essential need. Provides a roof over it. So what is your added, because you clearly talked about having a low appetite for debt at that point.
Yes.
Did it grow?
I have no appetite for debt.
No appetite for debt.
My mother used to say to me, if you can't afford to pay for it with cash, you don't deserve to have it.
Okay.
I've never forgotten that.
So that's an interesting
that's
point,
with spending, not investing.
Okay. Right.
Investing's different to spending. I don't borrow money. Yeah. I actually have, and I'm happy to share this with you. I have an $8,000 limit on my credit card, and every time I tap it, and it says declined, which it often does. I have to call my bank. I have a private banker. I have to call my private banker and I have to ask them to transfer the money, and then I have to fill out a form and then sign it and photograph it and send it back to them, and then they ring me to confirm it again. And you might think that's insane.
You put that in place yourself.
I've put that in place. I've put it in place. I don't have online banking.
Wow.
I do not have online banking, because it just forces, it's a massive inconvenience to spend money.
Okay.
Yeah, and it's just how I've done it.
So there's some guys in the States. Dave Ramsey is very
Money Mustache, all of those guys.
I've heard of Money Mustache.
Your philosophy personally to this date is to not leverage into...
I know leveraging into assets I've got no problem with. I feel I'm very confident in recognising value. I've developed an experience, and I understand the arithmetic. We've got a team of people who are dedicated to finding value, and there hasn't been a lot around recently. But to have a multi-million-dollar facility that you can draw down on at any time to take advantage of value when you see it, I think is invaluable. And so, give you an example, prior to the election in 2019, when everybody thought Labor was going to win and property was going to go south terribly, a property came up for sale, and I met the owner, and it was clear that the owner was needing to downsize, and without articulating it, I think he was quite concerned about the outcome of the forthcoming election, or the then forthcoming election. So we ended up buying almost an acre property in, very close to the city in Sydney, for less than it would cost to build the house. So effectively, we got the land for free. And then we ended up selling our prior property, our previous home. We ended up selling that a good couple of months after the election, when there was a shortage of supply prior to the spring sales, and we had 150 people at the auction, 10 registered bidders, 7 who actually bid, and it went to a beautiful young couple with young kids, and everyone's really happy.
Beautiful.
Yeah.
Well, you got the improvements for free because the land is where the value is in property.
You don't need to tell me that. I reckon the best property investment is actually a shed. Industrial property is amazing because you've got a lot of land and very little depreciating building, and you can replace it at any time. If you look throughout history at commercial real estate, particularly office towers, then over the life of the building, what you find is that all the income that's been generated has been ploughed back in to keep it up to date, so that you can keep it tenanted. And whereas so you've got a lot of depreciating building and not much land, whereas with industrial property, you've got a lot of land and not much building, and the economics of that look much better.
You refer to that as an inhibited returns, don't you?
Correct.
In terms of your principles of investing.
Yeah, there's a proportion of the income that's never free to spend because it's got to get ploughed back into the business or into the asset. That's exactly right.
And in residential property, which is where we play, we talk about 1.5% of the value of the asset indexing at 3% in our models.
Right.
So we're making sure that we keep the asset attractive and up to date for the end user to use it. Now, we don't mind good old wear and tear and reliable and durable assets, which is a bit like the sort of storage sheds and so forth. Because a durable kitchen can last you 25, 30 years. There might be the odd dishwasher that needs replacing and so forth. But it's the same sort of principles. You've got to factor that into your ultimate return. And if you don't, you're going to leave yourself short, and you're thinking, wow, look at this wonderful property, it doubled in value in 10 years or blah, blah, blah. But, what did it cost you to hold? And
well, 10 years doubling's not, it's 5 to 7%. It's okay.
Yes.
There's a lot of risk there too.
There is a bit. Obviously, when you add the yield on top of that, you are sort of talking 9s, 10s, 11s, 12s.
If it's a positive yield.
Yeah,
which after expenses sort of isn't in a lot of properties that are bought today.
Hey, I'm looking forward to sort of pivoting into your views on investing and what value investing is. But before we do, what I've observed and clearly seen in the last sort of 30 minutes or so is your ability to recall details when you're telling a story is remarkable. So have you got photographic memory? Is there anything outside of the average that's going on there? Because one of my questions for you today is I listen and I observe, and you'll recall a company and you'll talk about the balance sheet on this particular date, and then you'll say this particular part. How do you do that? Is that a normal mind, or is there
it's just normal?
But there's no photographic memory or anything?
I don't think so.
Okay.
No. I think you just remember stuff that's important to you. I do get in trouble sometimes not remembering my friends' kids' names, and that's not. And that should be important to me, but I just don't have the capacity to remember that as well. I find that I love my friends dearly, but if they've got more than 3 children, I can't remember the 4th and 5th. It's sometimes hard. In fact, It's interesting that you asked that question, because last night I was listing the names of the kids of some friends of ours, and I went through their names, and I said, "What's the fourth one?" And my wife's yelling out, "Jeremy." I'm going, "Oh yeah, Jeremy." So I have to work on. Yeah, so I clearly do not have a photographic memory, because I'd probably remember that.
Well, there's some advantage there, because it's to be able to recall that detail. But
my wife does get upset that I remember numbers and I don't remember people's names. Yeah.
Fair call. What is value investing?
Wow, I think it's investing. All investing should be value investing. It's different to price. It's knowing that what something is truly worth is different to its price. So property people will know, they'll know this intuitively. They'll go to an auction, a house sells, and you can hear them mumbling to themselves. They're all saying, "Oh, it wasn't worth that." So immediately there's an instinctive appreciation that what people are willing to pay for something is its price, but its value is something else. Now, that flies in the face of sort of accepted wisdom. Accepted wisdom or conventional wisdom says an asset is worth what someone else will give you for it. An asset is worth what someone will pay for it. Well, no, that's not what it's worth. That's what people are prepared to pay. That's the price. And the price will trade daily, and it could be very different to what the thing's actually worth. And the example that I use in my book is a company called NetJ.com. Back in the 1999 tech bubble. Yeah. It listed in November at around 50 cents, or the pre-IPO price was 50 cents. It said in its prospectus, I write about it in the book, it said NetJ.com conducts no substantial business activity of any description, and NetJ.com has no plans of conducting any substantial business activity of any description for the foreseeable future. Word for word, that's what the prospectus said. Remarkably consistent business model, never done anything, not doing anything, not going to do anything. And it went from a 50 cent pre-IPO price to listing at about $2. It was a backdoor listing, listed at $2, traded up to, I think it got up to about $8.80 or $8.88, and then subsequently fell to about 6.7 cents or 6.4 cents and was delisted. True to label, never conducted any business activity of any description. Someone was prepared to pay $8.88 for it. But the question I would ask is, was it ever worth that? And of course everybody listening would say no. It was never worth $8. It never did anything. But and that tells you that price and value are two very different things. So value investing is about paying a lower price than the value you receive, right? And so, the house that I bought recently, I reckon I got the land for virtually free, because if that building burnt down, it would cost me as much as I paid to rebuild it. So the land was almost not considered in the purchase price. So for me, that's good value. Now, a neighbour might say, "I think you paid too much." Well, no, actually, I don't think I did, because if you try and replicate what I've got, it's actually going to cost you more. So that to me was good value. That's an example of good value. But everybody has a different idea of what value is, and that's why there's tension at an auction. That's why there's tension in markets. I can sit here today and say I think markets are incredibly expensive. I think paying 370 times FY21 forecast earnings for zero is insanity squared. But there'll be someone out there who'll buy it. I think they're going to lose money, and time will tell. But yeah, that's value investing in a nutshell.
So I mean, we know your passion and process is about not buying shares. You buy businesses, or you buy a share of a business or a piece of business, I think is what you talk about. And in all this sort of market phases, I love the saying that you quote about, and I don't know who originally said it, but basically the stock market is short-term vote machine and then a long-term weighing machine.
It was Warren Buffett paraphrasing Benjamin Graham.
Yes.
So Warren Buffett used to use that quote a lot. He'd say, in the short run, the market's a voting machine or a popularity contest, and in the long run, it's a weighing machine. And then someone at one of the Berkshire Hathaway meetings said, "Warren, I can't find where Ben Graham actually said that." And then Warren said, "No, I think I'm paraphrasing him actually." And then he looked it up and put it in one of his letters. But it's important to remember that if property traded every day or every minute, if you could see the price people were willing to pay for your property every day, and it went up and down as manically as or manic depressively as the stock market does. People would trade property a lot more frequently than they do. You know, there'd be people who'd come home from work and say, hey, listen, 2 betters are going down. We need to sell this and get a 3 better. You know, they'd be doing really irrational things, which happens in the stock market every day, which is what I like about it. Because if you're rational with money, then you can actually see the market. And if you have a value framework, you can see the market for what it is. It does require patience, and that's hard.
Well, so what are the conditions that are conducive for you to be able to find value in the market? Because there's easy access to credit right now. So it means that people can pay prices using your definition well and above what the value is. So
yeah, correct.
Is this
and that's what's happening. That's happening. So we're seeing bubbles in everything. We're seeing bubbles in bonds. We're seeing bubbles in stocks. We're seeing bubbles in low-digit collectible number plates and collectible cars, and even in some property. Not so much now in Australia. I think that one's popped. But we wrote about it I wrote about it in the Australian for years, that this is going to end really badly for a lot of people, and that in particularly apartment investors, and that's happening at the moment. So in answer to your question, I think low interest rates. I think it's important to understand that low interest rates are generally supportive of asset prices through the present value calculation, right? So a $10 today is worth more than $10 in 10 years' time. But if I could invest an amount of money today to get $10 in 10 years' time, if interest rates were very high, I could invest a very low amount of money and I would end up with $10. If interest rates are very low, I can invest a high amount of money today and I'll get $10. So that's the present value calculation in reverse. As interest rates go down, it lifts the value of an asset today. It lifts the value of a future dollar in today's terms. So at low interest rates, assets drift up.
Rising
in value.
tide lifting all ships.
And then the transition mechanism, or the transmission mechanism rather, that causes that to happen is people migrate out of low yielding assets like cash and they move up the risk spectrum, and through that activity that pushes the price up to reflect the increased value. So over long periods of time, price and value tend to follow each other, but over short periods of time they get really out of whack on the downside and the upside. So your question was, what sort of circumstances would lead me to get excited? It's when an individual asset, its price is much lower than its value. Now that can still happen. So for example, even though interest rates have been dropping and share markets have been going up, we saw Telstra, for example, fall from $6.60 in January 2015, it was $6.60, and then January this year it got down to about $2.70 or $2.77, and that's where we bought it. Now everybody in Australia who follows my writing and articles about investing thinks I hate Telstra. But at $6.60, I do hate it as an investment. At $2.70, it becomes a much more attractive proposition. And it subsequently rallied to $4. So even though the market is in aggregate expensive, it doesn't mean individual opportunities can't be presented. And so we just look for those individual opportunities. There aren't many at the moment. So look, in an ideal world, we'd get a tremendous correction in the stock market. And anyone who's under the age of about 90, really, they're going to be net buyers. And so if prices are falling, you're going to be able to buy more at a better price. If you've got sufficient capital, then even if you're in your 80s, you don't mind a correction in the market. It gives you the opportunity to add to things with some income if you've got income from your other investments.
Well, you have a business that relies on seeking out these opportunities. Does it... you talked about patience before. It would require you to have a fair bit of patience if you're not trading and you're sitting there waiting for opportunities.
Well, just remember, I had to wait till next fortnight, right? Yes, so I learnt patience. Yeah. I learnt to be quite patient. I've been wrong on market valuations now for 3 years. The market has rallied, and I have thought I think it would be about middle of October 2016 or thereabouts, so about 3 years ago. I think that prices have been expensive from then onwards, yet they've continued to go up. So one view is, Roger, you're wrong, prices have gone up. The other view is those prices are temporary and they're just prices, not values. values have risen, but not to the same extent as prices. Yeah.
It's interesting. I mean, I do follow the value principles of investing when I'm looking at shares and so forth. But to quote Stephen Keen, who's a sort of economist and property professor, a university professor, sort of talking about valuations of land and residential property. That's the challenge around irrational exuberance, isn't it? And then what is a piece of land actually worth?
Yes.
If, he was quoting in the early 2000s, 40% correction and then another 40% correction, and I think he's gone different. So it's almost like...
To me, that I don't know those forecasts, but that's extremely unlikely that you see in Australia a 40% property correction ever.
Yeah.
And simply because we've got an oversupply. I'll give you an example. We've got an oversupply of apartments that I've been writing about for the last 3 years. And that's happening now, and everyone's seeing the evidence of that.
We've been saying it too.
But I also know from all of my property development friends, and I've got, they're very large property development firms that I'm talking about. They're family owned, but they're all billionaire families that we're talking about. Approvals for more apartments have just stopped. So there'll be a shortage in 3 years' time. The only question for investors, if your time frame is long enough, you will make money on property in Australia. But like my property that I owned for 13 years and I only made 3% per annum, you might not make very much, on an annualised basis. Still meant we just doubled over 13 years. But really, you'll do okay in Australia. You're not going to see 40% corrections unless you get a recession where you see, serious numbers of people unemployed. Then what happens is you get the marginal seller pushing individual property prices down. And of course, it's the marginal buyer and seller that determines property prices for everyone else. It's not what you and I do, sitting here being interviewed, running this podcast today. We're not changing property prices. It's the people this weekend that will determine property prices for everyone else. So if you get a large number of people who are forced to sell, then that can push the property prices down for everyone. But just remember, not everyone will be able to take advantage of that because there'll only be a limited number of properties that are being sold at that price. So the aggregate number will look low, the price will be low, but the value will be higher. And so if you can get the price, if you can take advantage of someone else's difficulty, which sounds awful, but that's basically what we all do when we're buying and selling assets.
Correct.
We're taking advantage of someone else's short-termism or whatever it is, then that's you getting value. Better, the value is greater than the price. You're paying a lower price than the value you receive, and that's what you want. And so I think that in all market circumstances, whatever the aggregate number is irrelevant. You're looking for individual opportunities, be it in the stock market with Telstra, or somebody who's lost their job and is forced to sell, and you pick up a property cheaply.
We talk about owner-occupier appeal as a consideration when you're looking to buy.
Well, you know more about that than I do.
And the reason
I've made 3% per annum on owner-occupier appeal.
Well, the reason we say that is because 70% of the market is controlled by owner-occupiers, right?
Yeah.
And they are usually irrational because they buy with their hearts, not their heads.
Yeah, they want something...
Correct.
Which is why you change all the handles on all the cupboards when your house is dated, and if you can, change all the taps. And if you can, renovate the bathrooms and update those.
That's it. Because that's where they make the connection.
Yeah.
And then all of a sudden, if proximity, location and all those things work, well, it's those irrational buyers because they are buying emotionally, not necessarily rationally. That's why we've always believed that, sort of a smart investor will be a price taker, not a price maker.
Yep.
So when they're coming to buy that one asset in that one street, in that one suburb, they're looking at what's going on in regards to that. And so it doesn't have to be the prettiest property, but in terms of what's going on, because the valuation of the land and the improvements on the land will be the aggregate of what's around them, and the identification and the sort of commonness of, the sort of commonality of the property you're trying to value. But it comes back to the concept for me around valuing land.
Yes.
How do I value land? I mean, what is, Point Piper, I can see $1 million mansion on the foreshore there.
Well, yeah, you're probably not going to get much for $1 million on the foreshore at Point Piper.
No, 100 million, I should say.
Yeah,
$100 million, my bad. and so where do I see value in that $100 million?
Yes.
Someone did, because someone bought the most expensive property in Sydney.
We also have a tax structure in Australia that preferentially treats the residential home.
The owner-occupied home,
The owner-occupied home.
So,
that does skew the desirability of expensive properties. People are willing to back expensive own homes because the gains that they make are tax-free. And remember, with prestige homes, it's always what basically you are buying is, forget about Point Piper or Vaucluse or wherever the suburb is, or Mossman on the North Shore. What you are buying is an option over any industry being successful. Because in Sydney, it doesn't matter if it's rubbish collection or tech or finance or investment banking, doesn't matter what it is, whoever makes a lot of money, they'll want a trophy home.
Correct.
And so what you're buying is an option over somebody wanting that home, and all they have to do to be able to afford it is be successful in their industry. So it's an option over someone's success.
Correct. If you multiply that out, that's exactly what's going on in terms of valuation of land from a centre outwards.
Yeah, because
they're all competing for that next location.
In my industry, we call that fungibility. One is swappable for another. It's transferable. So people often ask me when I was writing those articles about apartments and saying, look, apartments I think are going to fall. They're going to fall by a decent amount, and people who've paid top dollar and geared to the eyeballs are going to be the worst off. People would say, but what about freestanding houses? And I said, well, look, I can't predict how much they're going to be affected, but they will be affected to some extent, because if your 3-bedroom apartment falls by, let's say Steve Keen's 40%, I'm just using an extreme example for illustration purposes. If an 3-bedroom apartment falls 40% and the house price the 3-bedroom house doesn't move at all, well, guess what? There's going to be fewer people at the auction for that property, because they're going to say, do you know what? I know we didn't want to live in an apartment, darling, and the kids, don't get a backyard with a swing, but, there's a park across the road. Let's buy the apartment because it's 40% down. Let's not buy the house. So that, to some extent, the house will be affected, not to the same extent.
Exactly. You're 100% right.
But to the extent that people are willing to transfer their desire for where they live from one to the other, that's the transmission mechanism for the impact. The Chinese proverb sort of says, you drop a pebble in a pond and the ripples eventually affect all the pond to greater or lesser degrees. And so all property is affected if some of it is affected, but it's hard to predict or know to what extent. And then you've got, property in Epping in Sydney has fallen a lot, but property in the eastern suburbs of Sydney has kept going up. So the ripples may have affected it, but it had no effect. The ripples washed over, but people weren't affected by whatever caused that ripple in Epping. And
that's the scarcity of land component and the demand story to that. Yeah.
If your time horizon's long enough, you'll be just fine.
Well, that's the quality and time, which is critical as part of value investing, isn't it? You are identifying quality and you're overlaying that with sustainable competitive advantage on that quality based on your return on equity models that you use. Similar process. I mean, there are markets within markets when it comes to residential property, and we've been saying, since 2014, 2015, we couldn't understand the valuations in Sydney. We were like, what's going on here? I mean, the rising tide's lifting every property price, and we couldn't see the value in some of those areas. And we thought at some point something's got to give, and ultimately it did. But in this case, it was actually a manufacture correction by APRA to slow it down, because when we started to see 52% of all new lending going to investors, we have a serious problem. In the marketplaces.
And then 13% of all people, 18% of all people who'd taken out a mortgage in 15 and 16, who took out an interest-only mortgage, 18% of them didn't know it was interest-only. Then you realise you've people who have been too unsophisticated.
Yeah, agreed.
And presumably equally unsophisticated in the choice of property, and equally unsophisticated in the price that they paid for that property.
Yeah, that
was going to be quite telling.
Yeah, very telling.
Hey, you referenced Warren Buffett before. A couple of questions.
Yeah.
One, how much of an influence has that been on your
Huge
investing?
Huge.
And two, Charlie Unger and Warren talk about accumulating mental models so they can filter
frameworks.
decisions through that.
I talk about frameworks.
Yeah,
so I talked about having a value framework. Frameworks are really important. It's really important to understand a couple of things. One, having a mental model or having a framework for investing is helpful, and it will. If it doesn't give you the maximum return, it will save you from maximum losses. And then the other thing that I think is really important, in addition to having a mental, well, let me say it this way. I think the two frameworks that are really important is understanding the way the market behaves and understanding that it's driven by emotions at times. And so a framework for understanding how booms turn into bubbles is really helpful. And then understanding how to value a business is another framework that's really helpful. And if you can have those two, you're a long way down the track of knowing which assets to buy and knowing when people are overpaying for things or giving things away too cheaply. And if you can identify those two things, you're set for life. You really are. And you're setting your kids up for it as well. And that's why I wrote the book, because I want my kids to understand if I ever came to an untimely death, got hit by a bus or whatever it was, or a plane crashed, I want them to know how to do that themselves. Yeah.
So what's a day in the life of you? How do you stay across the breadth of what you're doing? I know you've got a team here. We're in your office, and there's plenty of activity going on in the background there. So how do you feel like you've got a finger on the pulse of most of the companies, or is there just a niche where you guys go, well, this is where I can focus? Because it seems to me like an extraordinary amount of information that you need.
There is an extraordinary amount of information. So I'm Chief Investment Officer. So my job is to actually look at the work that the analysts are doing, and I've given authority to portfolio managers to manage the portfolios. And in the investment committee meetings and in our research meetings, what happens is we're expected to read the research that's been written by the analysts and then to discuss each of those opportunities as they're presented, and then collectively make a decision with the portfolio managers about what goes in the portfolio. It's not my job to try and predict stock markets. That is a very difficult thing and pretty much a waste of time. And I've proven time and time again how wrong I can be at that. I get a few things right, like I got the iron ore price crash right, I got the stock market right back in the GFC, got the property market coming off right, but so what? You make money from finding individual assets that are incorrectly priced and taking advantage of that. So the job of the analyst is to say, here's a really good business, here are its prospects, here's what we think the market's getting wrong about it, and because of that we think it's actually worth this and the market's pricing it at this, and we think we should own it, and that's what we do. So my job is not to keep on top of world events. I don't care about certain things, but then we've got a team of people that do care about that. And they're keeping an eye on that, and they're factoring that into their mental models. So it's very hard to do if you're doing it yourself. You wouldn't try and do it yourself. Presumably that's why people employ you guys to help them do that, because you can, there are advantages in consolidating resources. Trying to replicate what other people are doing is expensive and a waste of time if someone else that you trust is already doing it well.
And it's the mission of our podcast to provide our listeners with those mental models that they can then overlay when they're making decisions about property. So it's not just dissimilar.
And or money management, and that's why, hearing case studies of successful people like yourself, Roger, is really helpful for them to sort of say, well, he's no different than us. If we have a framework in which we organise our money and, we have a mindset that allows us to invest and create wealth and all those types of things and get educated, as part of that journey is why this podcast is so rewarding for us.
I hope you'll give me the opportunity to share one thing though. It doesn't end with making the money.
Yes.
It ends with giving it away.
Nice.
I get enormous joy out of helping other people. Now my sort of philanthropic policy is not to spread it all around thinly. So my wife and I have selected 4 charities that we get very, very involved with, and we try to have a significant impact on those charities. So there's enormous joy in being able to change people's lives, and you can do it with a really small amount of money. You don't need to be a millionaire or a multimillionaire or a billionaire to start having an impact. You know, there's an organisation called CBM. And they're one of the charities that we support. And I'm not telling you this to promote them.
Share, that's fine.
But you know, for $35, I can give $35, and in 10 minutes, a cataract can be removed from the eyes of a mother who hasn't seen her daughter, and her daughter is 16, and she's going to see her daughter for the first time in her life.
Transformational.
It changes life. It's $35.
Yeah.
I mean, it's just. Why wouldn't everyone do that? You know, just go without a coffee for a week.
Yeah.
You know, and you've paid for changing someone's life, and then that woman can work and earn an income and start a business, and that's going to change her entire family's life. It's just
for once in a life,
for $35
she can have aspiration as well.
And I like high return. I talk in my book about high return on equity. Yeah. You know, high return on investment.
That is a high return.
$35. That's a massive return on investment.
Well, we'll put those details in the show notes. We'll get some of those details.
It's certainly refreshing to hear you say that. So the final one for me, Ben. Given I'm just keeping an eye on time and respecting your time. If someone...
I do have a few people looking over at me going,
yep.
Is he still in there?
Almost. But my final one is, if someone's listening to this and they have been reading the newspaper for the last 3 days and they don't have the same opportunity that you did to go upstairs and talk to that person,
yes.
What advice would you give to them that you would have liked to have heard back then that might set them on a path that they can set themselves up successfully and start doing philanthropic pursuits themselves?
Read prodigiously. Read everything there is about Warren Buffett, and then read all the letters that he ever wrote. They're all available online. Yeah. Even the pre-Berkshire Hathaway partnership letters are available online. Read everything you can. Read your books by Peter Lynch, Howard Marks, Warren Buffett and Charlie Munger. There's a great book by Roger Montgomery, Valuable.
I've read it.
That's probably, you want to read that after you've read. There's an author, Roger Lowenstein, who wrote a book called The Making of an American Capitalist. Read that book, Richest Man in Babylon, which, by the way, is, as an adult, sort of probably a fairly painful read, but it's really quick.
Oh yeah, and it's free.
And the other one that the other one that I read when I was really young, I think I was about 10 or 12, I read a book called How to Win Friends and Influence People. And do you know what it taught? It taught you to listen. And this has been about me talking, forgive me for that, but...
that's the way we wanted it.
Yeah, it would be funny if I was listening to you. It would be a funny interview. But it was a great book because what it taught, it taught me, if I took one thing away from that book was that if you get into a conversation with someone, ask them questions, listen to their answers, they will walk away and say, you are a great conversationalist. And they want to have you back to their next party, or they want to have you back at the next opportunity to invest in property or whatever it is. If you listen to people, that gets you a long way in business.
Couldn't agree more. So an extension of that, are you still a reader? Or
yes.
Yeah.
No, I read a lot. My wife criticises me for not reading fiction, and I wish I had time to read fiction. I tend to read biographies about other investors and other business owners, and that's, I find that enjoyable. Yeah.
So I know we're very, very short on time. So what sort of... Is there any trends in mindset that you've seen in all of those people that you've read? Is it patience? What is it that you get from reading those in terms of why are they great investors? What was it about them that they could see basically the signal between the noise?
Do I think it was Richard Branson who said, oh no, it wasn't, it was way before Richard Branson. Could have been Jack Welch.
In his winning book?
Yeah, the harder I work, the luckier I get is the quote. And there's no such thing as luck. There is happenstance. I accept that. But by working hard, more of that comes your way. You find opportunities. You've got to be able to seize them. I think CEOs And successful people probably don't give enough credit to how many sliding door moments they had in their lives, that had they taken a different path, it would have been a very different outcome. And they weren't in control. You know, I recently did a talk for a boys' school here, a private boys' school here in Sydney, not where my kids go, a different boys' school. And I said to them, you know, how much control do you think you've had over your life so far? And they were all nodding, going, I'm in total control of my life. Well, hang on a sec. You didn't choose this school. It was chosen for you on the day you were born by your parents. So if you had no control over being here today, how much control do you think you have over the rest of your life? You want to take opportunities when they're presented. So you want to, now you're at a great school, take the opportunity, make the most of that opportunity. But there are those sliding door moments that you didn't have control over. In answer to your question, I think it's really important to recognise those moments. You know, and I think that the most successful people in the world sit back and before pouncing, they reflect on that and they say, is this one of those moments where if I get it wrong, it's going to be really bad or really good? If that's the case, then I'm going to get some advice. So who do I know that I can speak to help me in this situation?
You look at Warren Buffett, where from 50 and on, that is where he's made most of his wealth. But those life skills and all those life lessons and everything that has got him to that point to make that.
Well, it was the exponential part of the compounding curve that hit when
Yeah.
he sort of hit 50.
Yeah.
That's when it started to go exponential.
Yeah.
That's exactly right. And it's reflected in a book called Snowball.
Yeah.
And the reason it's called Snowball is, you know, you want to start as early as you possibly can with a chunk of snow,
Yeah.
and then you want a really long slope.
Yeah.
You know, and that's basically
True.
your life, and
Yeah.
it will collect more snow.
Beautiful.
But you just keep repeating it all the time.
Yeah.
Yeah,
Terrific.
yeah.
Roger Montgomery, thanks for joining us on the Property
An
Couch.
absolute pleasure. Thank you for the opportunity to share
Thank you.
those memories.
Wonderful.
Thank you.
Awesome.
So, Ben, not only was that a great interview, but it was lucky that we even pulled it together because we normally
We didn't have
fly-
Ibis with us. We didn't have the Stig.
She was overseas, and so she gave us very
Clear instructions.
on how to push record. And I've got to say, there's more to it than you think.
Yeah.
So it was up to you and me.
Yeah.
And thankfully, we brought home the audio. But
Let's talk about Roger. I mean, first of all, we thought we had limited time. Well, he gave us more time. So we realised this podcast is a long podcast, right? It was all that we're talking about here today. But again, some themes keep coming out for me, Bryce, in terms of these. I mean, we have a list of people across Australia and potentially overseas as well who we'd like to interview for the podcast. What we got and what I keep getting from these people, now, bearing in mind they are financially free, but I tell you, you know what I get from them? Consistency. Consistency in their belief system. They don't tack, they don't change, they don't waver.
the grass wasn't greener on the
The
other
grass
side.
wasn't greener on the other, whether it be Paul Clitheroe, you know, or Roger, or any of those guys, they stay true to their investment principles, their frameworks that they've been able to develop over time. Now, earlier on, they were learning, as Roger was. He was learning, he was green just like anyone else, but he's then being able to sort of say, I'll take that bit and I'll lock that into my investment theory. I'll take that and I'll lock that in, and then I can understand the fundamentals of what runs a business. And then it's those fundamentals inside that business. It's the sustainable competitive advantages that they're looking for in terms of how they do it. It's the management team. All of those things ring true in terms of how he's been able to invest. And so, you know, it's Montgomery Investment Management is the name of the business that he has successfully set up and runs. We
were in his office. It was an impressive outfit, but what I remember as I was guiding the interview, and I'm thinking, gosh, I'm looking at the time, I'm looking out the window, and his staff are saying, you know, we need
You need to be somewhere
because we
else.
had a million other questions
We
we could have asked him, but we
maybe
thank
one
Roger.
day we'll get Roger back on.
He was very generous with his time.
Yep.
He was so open, made us feel welcome in his space, and the conversation reflected that. So. There you go, folks. Hopefully that was of huge benefit to you as we celebrate our 250th milestone. So, Ben, my life hack today is to you.
Oh, okay.
Right? Now,
This is new.
I was just giving a
Did
frown.
you know what so you didn't know about this either, Ives?
Now, I'm looking at you, Ives, just to see if there is a Android version of this, because I probably should have.
Let himself down, hasn't he, Ives?
Well,
I mean, he had enough time to prep. Been away for a couple of weeks.
Well, he's back, right? He's back. So, well, I've got a prep for Life Hack and Mindset Minute, and I usually feed you a Did You Know? So,
Not quite sure about the did you know bit, but anyway, you do have to do two bits of work and hold this whole thing together. Yeah. That's the truth.
We all play to our strengths, mate. So text messages, Ivis. How often would you send Ben a text message and he responds? Percentage out of 10. He's good now? Well, that doesn't help my story. For me, we'll just talk about the past, right? Probably get a response.
Pretty good now, that's all I heard.
One out of 5. I would have thought 1 out of 5. And I must admit, he's actually probably up to 2 out of 5 these days.
Yeah.
Did you know on the Apple, Ben?
Well, I only respond to important things.
If someone sends you, well, sometimes it's, did you acknowledge that you got it?
Oh, right, well.
Right. So now, Ben,
right, okay.
You can actually press the bubble in the message.
Right.
Hold it down for a second and a half.
Uh-huh.
And then some options come up, and you can do thumbs up, thumbs down, exclamation mark, ha ha. There's a couple of emoticons in there.
2 fingers up called exclamation mark.
Exclamation mark, exclamation mark.
Is that what that means?
No, I'm just trying, like I've got one hand, I'm using the other hand to do something else.
Sorry, I thought that's the peace symbol.
Oh, it's a tough crowd.
Well, I would have done exclamation mark.
Okay, all right. I should have seen your counsel earlier.
All right.
So for you,
yep.
That's, mate, if I send you a text message,
yeah.
I've got you a life hack. It's a quick way just to
right,
respond
just
back.
A little quick one.
Yeah.
Got it. Yeah.
All right. So Ben,
yeah,
you gonna use it?
Very good. I'll try. I'll do my best.
Is there an Android? Do you do that on Android?
If I do, then
you can't, Ivis. Do you know how this came up? and I played that beautifully, right? Because Ivis comes up to me and I send her a text. She goes, "How did you do the thumbs up on the message?" And I went, I just showed her. And she goes, "Oh, you can't do that on an Android."
Oh, well, watch this space. Don't worry. I mean, Apple's copying the 3 cameras on the back of their phone, so I'm sure at some point that Android will catch up.
Animated over there, Ivis now. So, Ben, did you know?
Did you know, Bryce? Well, I thought, in celebrate, a couple of things. Okay. I'll go with a news story first.
All right.
Fed Reserve.
Okay.
So the Federal Open Market Committee, so it's a committee, it's like, our RBA board, right? They met last night, announced a decision 4 a.m. this morning, which was the Fed rate cut by 25 basis points. So they have a range over there, so they don't actually have as a fixed number. So it's 7.25 to 2%. So that's 25 basis points cut. It's the second cut this year. Interesting, right? Because their economy's going okay. If it wasn't for Donald Trump, in terms of his agenda to try and... I mean, he's talking up negative rates because he wants the economy booming and the markets booming because he thinks that that's good for his re-election. But what I do like about... It's total truth, Ivis. That's the politics that we're talking about here. Act as appropriate to sustain the expansion. So that's their positioning. But there was dissension in the ranks. So it wasn't a unanimous. So there were some people who wanted a 50. Some people, like 3, said, no, don't cut them. So that's a good signal to the market that we're not going to see them necessarily just bowing to Donald Trump's tweets about cutting the rate. They'll act appropriately to sustain the expansion. So there you go on the news front.
Yeah, nice.
Now I also promised at the start of this very long, epic 250th episode, Bryce, that we will talk about some of the stats. All right. So the Did You Know this week is about our downloads.
Yep.
So where do people listen to us, Bryce? Where do they listen to us?
Bendigo, Albury.
Yep, definitely. You would think that in Australia, these are the iTunes numbers. Okay, so it's not all of the stats, but in Australia, there's been 4.7 million downloads. What do you think was the number 2, Bryce? Number 2 country where we got our second lot of downloads from?
The
UK or US? Or
UK.
Wrong, Bryce. It's US. 75,000.
You're better at your lip reading.
75.
I thought you said UK.
UK had 57.
Yeah.
I thought New Zealand would do a little bit better for us.
New Zealand across the ditch.
Well, we do get a few people reaching out to us from the NZ. We had 55, so they came in 4th. Round out the top 5, Singapore, we had 25, Japan 19, the UAE, United Arab Emirates 16, Hong Kong 15,000. Now, Bryce, we also had one download from a country in Africa called Sudan. Ooh. So thank you to that one person in Sudan, and we are across 198 countries.
Wow.
So 198 countries, over 5 million downloads. That is my Did You Know for this week.
Well, thank you to all the expats who live in those countries.
All those people who are interested in maybe investing in property in Australia.
Exactly. So there you go. Epic 250th. Thank you, Roger. Thank you, Ben. Thank you, Ivis.
Yes.
We appreciate it.
Thank you, Bryce.
Now, Ben, if anyone has made it to the end, make money simple again. .com.au. Go and
free
get
book.
the free book.
Get your book. Get your Choose Your Own Adventure book.
And if you appreciate the gift, please tell someone else to go and take it as well.
Yeah, get in there and get as many copies as you can. Or grab the PDF and send it on.
Yeah.
Get on the platform.
Exactly, Ben. Until next week.
Money, Bryce, money. Make money simple again. How about knowledge is empowering, but only if you act on it?
That would be good. All right, folks, we'll see you next week. Hey there, folks. Bryce Holdaway here. Before you go, if you're new to our community and only listened to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now, for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarizes the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more. And you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.